We're going to be joined today by Tony Stools, CEO of Mpac, and Will Wilkins, CFO of Mpac, who announced their half-year results this morning, ahead of expectations, a phrase we all like to hear. So we will be taking Q&A at the end. If you would like to submit them as we go through the presentation, you can do so through the Zoom icon. Otherwise, without further ado, I shall hand over to you, Tony.
Yeah, thank you, Hannah, and welcome, and thanks for joining today's webinar, everybody. Yeah, just a way of summing up the first half of the year, I would say that Mpac returned to a growth trend with a very strong commercial period, which will drive revenues into 2022 and brings further assurance of Mpac's future growth prospects. There were challenges in the business during the first half in terms of headwinds from the ongoing COVID situation, travel restrictions and workplace disruption, supply chains and key skilled labor constraints, all of which were very well managed by our capable management teams. Strategically, we made good progress too. Switchback, acquired last September, continues to exceed management's forecasts, while simultaneously generating sales synergies across the group. And they've also successfully moved into a fantastic showcase facility in Cleveland in August this year. So all in all, very promising set of results, and we're proud with the progress that we've made in the last half a year, and we're confident that Mpac is on track to achieve its improved result for 2021, as Hannah just said in the introduction, and a great basis for 2022 and beyond. So we can go to slide 4, Hannah. Just some of the key highlights I'd like to bring out there. As I said earlier, the strong order intake and the recovery that has continued through July and August. So we've really now got a very solid order book to finish out this year, 2021, and a really good start for next year. So we're pleased by that. The OE trend has returned, so that is projects, of our capital equipment. The growth's returned. And what's particularly pleasing is that with the sales of newly developed products, we launched a new range of cage packing products a couple of years ago. They've took a little while to gain momentum, but they're now on the approved suppliers list of a number of confectionery FMCG companies, which is really pleasing for the team to see that. And we're now starting to see volume sales generated. The service business continues to progress, and the service result is better half year on half year than previously, and that's in part down to the US gaining momentum. We changed the business approach for this year, including switchback, and we now go to market with a single service proposition in the USA, which is also progressing, the business there. Margins showing a positive trend year on year. We can see now that the margins have achieved 33.5% gross margin, and that tips us over to the 10% ROS that we had in our original strategic forecast. And then the last bullet point on that slide is the energy storage opportunity that we'll talk about. We have a case study slide later in the presentation, but I think that could be, again, a fantastic new opportunity for the Mpac group in a third industrial sector. So moving to the next slide, please, Hannah. Yeah, so for those of you who are not that familiar with the Mpac story, we can, I'll start by saying we're on a transformational journey. We're a global leader providing full line packaging and automation equipment solutions to the growth sectors of healthcare and food and beverage. They're our real focus areas. We have been working on what we call the One Mpac strategy now for a couple of years, and that will really come to fruition in 2022 when we go to market as Mpac, with strong product lines with our different companies, but they will become product brands. So we'll offer them as part of our portfolio. So that's the Lambert, Langen and Switchback brands. We offer full solutions, as we call them, in the marketplace. So that's primary packaging, secondary packaging and end-of-line case packing. And just to put that into perspective, what do we mean by that? Well, we are the providers of equipment for FMCG companies to pack their products. So we're providing the equipment for them to pack their product, and then they will distribute it onto the consumer. So primary packaging, if you think about a chocolate bar, the chocolate bar is the raw material product. Putting that in a plastic wrapper is primary packaging. Putting those packed or those wrapped chocolate bars in a box for display purposes in the retail outlet. That's cartoning, so that's secondary packaging, and then putting those boxes of biscuits in a case is case packing, end of line. So we cover all three of those in food and beverage and healthcare. How do we differentiate ourselves from the competitor? Well, global presence is a real USP with our customers. Our ability to innovate and flexibility in service is the areas where we know that we provide the customer with a really differentiated offering. We have 4 main locations. You can see there on the map. We've recently expanded our facility in Richmond, USA. We only acquired the company last September, so we're literally a year down the road with Switchback, and we've already moved to a facility that's 3 times the size of the original facility, so really poised for long-term growth in the US market. We've been implementing common infrastructure systems across the group over the last couple of years, and that culminated this year with going live on the ERP systems across the three sites before Switchback, and that's been very successful to date, and we're starting to leverage some of those benefits now with working on projects across multiple sites in not only engineering hours but also assembly times. And then the final point is the integration of our Coventry facility. Some of you may remember we had a facility in Coventry, which was our headquarters. We've now sold that facility, and all the business is now in Tadcaster, and that is also the headquarters of Mpac in the UK. So hopefully that gives you a good idea of the company. So the next slide, we're talking here about what's our proposition to the marketplace now, our full customer offer as Mpac automation ecosystems. So whole line, I spoke to that earlier in terms of offering our customers full solutions with automation, primary packaging, secondary packaging, and end of line solutions too. Whole life, well, this is our service proposition. So to ensure our customer gets, a really good return on investment over the whole life of the equipment. So we can be there every step of the journey with initial commissioning and ramp up through to reconfiguring the lines, repurposing for different products, improving the efficiency through the life, and then finally looking at how the customer moves into the next generation of automation equipment. In terms of the whole planet, our position here is that we can work with, our carbon footprint as a company. Mpac is very small, but we can really help our customers to improve their efficiency, reduce their waste, reduce their carbon footprint, and that's through our service offer and our Industry 4.0 digital technology products that we can now offer our customers to really look at optimization of their equipment over the whole life, reducing stoppages, waste, and downtime. So I think we go to the next slide, please, Hannah. If you look at our business model, and if we go from the top right there, round the outer perimeter, you can see that we operate in 5 different areas. And just to give you a perspective on that, consult is a key part of our business when we're talking about new projects, and I'll come to that with the FREYR example and case study later in the presentation. But it's only 1% of what we do, but it's a very important part to do proof of principle work with the customer that the customer pays for, and we both get reassurance that their concept can be delivered into an industrial solution. Design and build, that's our project part of the business, and that's in the last half year was 73% of what we do, so that's the OE projects. Installation, that's a derivative of design and build because we install the equipment, commission it, and that's about 4%. The one I want to bring your attention to is the monitor. This is where we're investing, and I have been investing in Industry 4.0 solutions, digital technologies to really help our customers to improve their productivity, reduce their waste, and that's currently 4% of what we do and growing. And then optimize is our traditional service offer, and that's around 18%. So monitor and optimize is what we call our service business, and combined you can see that's 22-23%, but monitor is really where we want to put the focus going forward. Next slide, please, Hannah. The addressable markets, well, this slide hasn't really changed since the last presentation. These are the latest numbers from the Trade Association. But what I would comment on here is that the COVID resilient markets, both food and beverage and healthcare. Food and beverage has proven to be more resilient, and over the last half year and certainly the last couple of months has really has been a strong growth area, a stronger than we expected growth area. And why is that? I think the COVID restrictions continuing, but lifestyle changes. We've seen in the food and beverage, particularly things like frozen food, which is on the slide there, ice creams in the American market, plus nutrition bars. These have been really good growth areas, good strong areas with the FMCG companies in that space. Healthcare, slightly down on the previous numbers. I think they took a much more conservative approach during COVID. Investment decisions were put on hold for a period, but we've been speaking to our major customers in this space, and the investment decisions are returning, and we've seen a flow of orders over the last 2 or 3 months in healthcare. So that's now returning back to where we were previously. The mega trends continue. You see over on the right hand side what the mega trends are, but I think labor saving and automation is becoming much more a topic in our industry. Previously, it was challenging to get a return on investment for end-of-line case packing. They could always substitute. The alternative was for manual labor, and particularly in some parts of the world, that's very cost effective. So it was always challenging to get a good return on investment proposal to be agreed by the customer. But we've seen that transition, and as I said earlier, we're very pleased by the growth in our case packing product lines, which we developed a couple of years ago. And they're now on the approved supplier list with some of our major customers. So that's really reinforcing that automation driver as a mega trend. Energy storage may well be on here next time. We've got a slide on the FREYR case study later in the pack, but we see that as a very exciting market opportunity that could be a major market sector for Mpac going forward in the future. Next slide, please, Hannah. So yeah, focus here on what we've been spending our time on. I have to say up front, I'm really proud of what the team's achieved in challenging circumstances, dealing with the headwinds of the COVID situation and continued restrictions to travel and movement of the people. Also dealing with the supply chain issues that we're all aware of, and the constraints of key labour. I think the teams around the business have done a really great job in moving the strategic agenda forward. What I'd like to just focus on from the 2021 progress is building prospects. We've invested heavily in our website over the last year or so, and in social media. We had prior to last year 40% growth in our social media activity. That's grown a further 12% in the last half year, and we've now got 17,000 followers. So I think that whole commercial approach and building a marketing platform, which was accelerated due to COVID, but has really started to differentiate us in the marketplace. So pleased with how that's progressed. On the operational efficiency side, the rollout of the ERP system. So we've now gone live on the 3 sites prior to acquiring Switchback, and that is now showing absolute benefits to the business in terms of being able to move work around in terms of engineering hours and assembly. But one of the other benefits is that now we've got an integrated ERP system. When we do hear about supplier lead time challenges, we can reschedule that through the systems and see whether that's on the critical path for the project to be delivered on time or not. So we can help our suppliers prioritize. And this has been one way we've managed to navigate the supply chain issues thus far. It has had an impact on lead times across the industry, but as a business, we've managed to maintain our sort of responsiveness and agility around that topic. And then innovation, I can talk to really there the products and the case packing solutions. We launched them maybe 2 years ago now. They're now in that industrialization phase, and we can see the volumes picking up. And we're spending time now with customers configuring the customer specific part of the solution to their needs. And as I say, we've gained acceptance on some key customer approved supplier list now, which is really great for the long-term evolution of that product line. If I move to 2022, one of the key things is the launching of the switchback in EMEA. We've got the new facility in the US, so from a production of the standard modules, that's more than taken care of. We will import the partially configured product into the UK, and we'll do late configuration in the UK so that we can cut the lead times to customers. We've now looked at the market, and we've got a very clear plan of approach into the market. A lot of this level of product can be sold via electronic mechanisms, using the virtual world. So we don't think we need an extensive sales team to promote this product. We'll use our existing sales team in part, but rely a lot on our marketing skills over the last couple of years. So we're really excited about what we can do with switchback in the next half year. In 2022, we'll look at the innovation for make service business. We're launching the Mpac Cube later this year. What's the Mpac Cube? Well, it's our package of digital technologies around service. So in there, we'll be pushing advanced engineering options, information management, gathering information from the machines. The advanced engineering is things like digital twin, to make sure that we can really understand the complexity of the solution in the virtual world before we start to go hard on designs and procurement. So that will give a more robust solution and accelerate the development phase. I just spoke about information management, connected services. That's connecting to the equipment in the customer premises, providing insights, core services and training. So we're packaging that together as the Mpac Cube. And that will be our digital technology service offer that we'll make to our customers globally going forward. We talk here also about energy storage. We're at the start of a journey in that area, and we'll spend the next few months really looking at what the opportunities are in that market, where Mpac's positioned today, what we need to do to adapt, because our goal there would be to become the preferred supplier into that sector, and really be the pioneers to make sure that we are at the front in terms of future developments. And I'll come back to that in the slide later. And then communications, we've just upgraded all our internal systems. So the whole Mpac now is really a community. They're on one network, one set of systems, using Microsoft products, including Teams. So it really does foster that connected relationship across the globe, as opposed to what was in the past, different businesses in different time zones, in different jurisdictions. We've now got that community, we've got the connectivity to bring them all together and work as a common team, to the benefit of our customers. Next slide, please, Hannah. Yeah, I just thought I'll focus here on two main areas. The first one's switchback and what we're doing with the business in Cleveland, Ohio, and the next one will be on the FREYR project. Just as again, for the people who may be not so familiar with the story, why did we buy the switchback business? The strategic fit for us was on the secondary and end of line case packing products, so cartons and case packers. Switchback offered a product line which was at a technology level lower than we had in our portfolio, and a price point that was lower as well. And that expands our customer base, because quite a lot of our customers were asking for two-tier solutions: high speed, highly automated solutions, maybe lower speed, more lower investment levels, so that they could adapt to move that equipment to other solutions later in the way. So certainly switchback fitted the bill there. The location in the USA we felt was really important as well. And then the opportunity to expand the business into Europe and potentially Asia going forward. So what I can say is in the first 12 months of ownership, they've made really good progress. They've exceeded our expectations when we acquired the company in terms of order intake, and they've been building revenue as well and exceeded our expectations on that. And I have to say, the management team locally have done an outstanding job. They've continued to grow the business whilst integrating with Mpac as a group, while simultaneously moving, which they did in August, to the new premises. And the new premises are a high-tech campus environment. It's the start of a new business park in Cleveland, Ohio, that was formerly a retail park. And we're one of the first two people to to move on to that site to generate that sort of high-tech campus environment. And you see there from the feedback of the staff, they're absolutely delighted with what's going on. And we look forward to leveraging that site as our headquarters in the USA, offering all our product lines, Lambert, Langen, and the switchback product from there. And we're, as I said earlier, we're now starting to see real synergies across our different products. We're talking to customers and they are buying product lines from Langen and product lines from switchback to work simultaneously on the same product. So it really is becoming a full integrated part of the solution we can offer our customer. Thank you, Hannah. Next slide, please. So yeah, the FREYR opportunity. We put out an RNS a couple of months ago to give the investment community the heads up that we'd won this development project with FREYR. Some of you may be asking, who are FREYR? Well, they recently listed on the New York Stock Exchange. They managed to raise, I think it was nearly $1 billion in order to fund their growth over the next few years. They're a Norwegian-based company. Why Norway? Well, they have cheap energy costs because of hydroelectricity, and they really do believe, and clearly a lot of people are backing them, that they can be delivering the energy storage cells at a low cost point to drive the demand around these, around the energy storage systems going forward. And just to give you an order of magnitude, and it's early days, we are still putting the numbers together ourselves and understanding the market. But what we can understand is that the market by 2030, which is 9 years from now, is scheduled to be 5,300 gigawatt hours of stored energy is required, mainly driven by electric cars, because of all the governments are transitioning towards there, and you can see all the manufacturers. But the reality is that if you add up all the plans that are currently known about, that only equates to about 1/3 of that capacity. So there really is a lot of demand out there for stored energy solutions. And just to put that into order of magnitude, one of the development line we're providing to FREYR will provide 1 gigawatt hour of capacity. So that, you can do your maths yourself. That's 5,000 or so more lines required in the next 9 years. So I'm not saying for one moment that that's Mpac's opportunity. What we're saying is that we're very excited to be on this journey. And what we're also saying, it's not new for Mpac. It might look like a big adjacency, but it isn't. Why? Because they've been working on it in the Tadcaster facility for 4 years. Been working with the technology provider, which is a company called 24M, pictured on the right-hand side of the slide. And 24M licensed the technologies to FREYR to make the industrial batteries. And why do I say that it's not new? Because we've been working at, and we have some core competencies in web handling and automation that suit this product. If I just explain the products on the right-hand side in the picture, that's actually a plastic film on both sides, the back and the front. Inside of the plastic film, there is an anode and a cathode. So that's an aluminium foil and a copper foil. And inside of those, there is the lithium ion, which is a slurry. So we've got existing competencies in handling the films, so the plastic and the foils, and welding those together. The new thing for us is the slurry that's being contained within the welded. You can see the outline perimeter there, that's contains the slurry. But we're not actually taking responsibility for that. That is down to 24M as the licensor of that technology. So I feel confident, and we've done our due diligence. There's 46 modules on the line, and we've technically assessed, risk assessed. So we feel comfortable with that. So I do feel confident that we are more than capable of providing the technology. What we need to work on now is really what's the market opportunity. FREYR are talking about several gigawatt factories in Norway, and each of those is a multiple of 5 to 10 lines. So we can all sit here and do the maths. I think the next stage is to talk to them at the end of the year about their next development, and we'll come back to you when we have more information around that. Thank you, Hannah. And yeah, in terms of sustainability vision, I think I mentioned before that Mpac Automation's ecosystems is not a high carbon footprint business. Our opportunity lies with our customers and helping them to address their needs. to improve sustainability and reduce their carbon footprint. And we can do that through waste reduction and efficiency gains through the OEE, improving our customers' OEE, and a 1% improvement in efficiency for an FMCG customer is millions of dollars to their bottom line a year. So we really do feel as though we've got a compelling story to help them on their journey, and it's a win-win situation, because what that means for Mpac is it's covered in our strategic vision to make service a business. We have the enablers with the Industry 4.0 products and technologies, so that will, if we're the right partner, and we believe we are, generate increased revenues and margins for Mpac, and will also reduce waste and improve the sustainability of our customers and improve their bottom line too. So we really do feel as though we've got a win-win situation. And with that, I'll pass you across to Will, who'll go through the numbers in some details, and then we'll come back with an outlook. Thank you, Will.
Okay, thank you, Tony. Hannah, would you like to move on to the next slide? Thank you. So I'll start with the financial highlights for the first half. So overall, a very strong financial performance with growth over half year 1 2020 in order intake and revenue for both our original equipment and service side of the business, and in profit. But starting with order intake, so Tony mentioned previously that strong momentum that was gained in the second half of last year, that included at the time an uplift in the number and value of new qualified opportunities that we were bringing into the business at the time, and that's helped to contribute towards a strong increase in order intake in the first half of 21. So we're reporting 51.7 million of order intake, and that's 69% above the prior year and 40% above prior year on a like-for-like basis. So what's driving that? Well, the main increase is the original equipment side of our business. That's shown 97% growth and 58% growth on a like-for-like basis. And then breaking that down a little bit further by region, the Americas region again has performed very well, 60% growth on a like-for-like basis, so really strong performance in the Americas. Considering EMEA for a moment, whilst order intake in the first half of 21 was below the equivalent period last year, the pipeline for new qualified opportunities in the region is improving. And we've got an increased level of confidence that the outlook for the region will improve. And we've already seen some strong order intake in the first half of Q3, July and August, from the EMEA region. So there's reason to believe there'll be a rebalancing going forward. And then some comments by sector. Tony's alluded to that food and beverage sector has been particularly strong during the pandemic, and that's been the same for Mpac and same for Mpac during the first half of this year. We've seen new order growth for original equipment in the food and beverage sector, again, especially in the Americas. If I move on to revenue now, so we're reporting revenue of 44.2 million, that's 20% up on the prior year. There's a bit more detail on revenue on the next slide, so I'll skip on past giving too much detail at this stage, other than to say you can see on the graphs on the right hand side there that service has got quite a nice correlation of growth over the 5-year time horizon. For OE revenues, well, there was a bow wave of revenue that moved from the first half of last year into the second half of last year, smoothing that line out on account of the COVID crisis. I think we're broadly happy it's moving in the right direction and showing the right time horizon growth also. So that's really strong order intake growth, plus the revenue profile for the first half has generated a closing order book at the end of June of 62 million. That's up 11% on the opening order book, and it gives us a lot of transparency and visibility over how the revenue profile will develop second half of this year and into the first half of next year. If I move to margins and profitability, so we are really pleased with gross margins that we're able to report of 33.5% for the first half. On the right hand side, you can see the graph there showing margin development over the time horizon. So really strong performance in the first half. And again, what's driving that? Well, part of it is due to the mix of very good margin OE projects that we've been working on, and part of it is due to the group leveraging the prior investment in this one Mpac business model and systems, and the prior investment that we've made there to be able to really utilize resource across the group as revenue grows. So the growth in revenue and margins are, of course, the main drivers to the increase in underlying operating profit, and we're reporting 4.8 million of underlying operating profit, 4.7 million of underlying PBT, both significantly up on the prior year, and that falls through to a underlying EPS of 18.3p, up from 11p in the equivalent period last year. And yeah, we're really pleased to be able to report both growth in revenue and growth in margins consecutively. It really reinforces that the group has made that step change in profitability. I'll touch on operating cash flows and net cash. So you see that we're reporting a cash outflow in the first half of 3.3 million. That's operating cash outflow. The drivers to that, there's a cash bridge in a couple of slides time, but I'll refer to it now. So we have an increase in working capital of 7.2 million in this year. For those of you who followed Mpac, you may recall that in 2020, the year-end results and presentation, we reported a 7.5 million reduction in working capital. So at the time, that was heavily influenced by the timing of deposits that came in just before the end of 2020. So there is a natural unwind of that reduction in working capital as those projects on which we receive the deposits move through the business operationally and move through the accounts and through the balance sheet. And worth pointing out as well that those working capital movements in the first half of the year are very much aligned to our expectations and our forecasts internally for the half year that we'd made at the beginning of the year. So where we expect it to be. So cash at the half year is 11.2 million. Yeah, again, worth saying that's broadly the low point of the first 8 months of the year. And cash during Q3 has shown a very positive development, and we're now broadly back to the position that we started the year in terms of net cash. Next slide, please, Hannah. So a little bit more detail on the income statement. Some of these points have been covered, but I'll start with revenue. So 20% growth in revenue. I said the bulk of that was from our OE side of the business, but we are still pleased with to be able to report growth on the prior year for service. But while the service was very strong in the first half of 2020 as customers' buying habits changed during the pandemic, but also we've continued to have the challenge of struggling to get our engineers in customers' premises whilst travel restrictions remain. So with those restrictions still present, to be able to report 5% services growth is clearly a positive KPI metrics that we're reporting today. I've said before, the order intake growth was very much weighted in the Americas, and naturally revenue by sector is the growth is coming from the Americas region as well, albeit we do expect to see a rebalance in half year 2 with a stronger outlook for revenue in EMEA. Talking about SG&A costs, you'll note from the slide that there's an increase in SG&A costs. The comparator clearly was a period where Mpac, like other businesses, were taking one-off measures to reduce costs, and I think where we've got to now is back to a more normalised cost base, and that is the main driver to explain the movement in SG&A costs this year to last year. Underlying profit margin is 10.9%. Said it was supported by some very strong OE margins, but it does give us confidence that we're on the right path to meet our long-term goal of an ongoing and sustainable 10% return on sales. A couple of comments on what's reported below operating profit. So non-underlying items include our pension admin costs of 600,000, and we have amortization of the acquired intangibles associated with Switchback and Lambert of 900,000. And we're showing there a net tax charge for the half year of 700,000. It will be minimal cash tax in the year, as we have previously capitalized some deferred tax assets, which we'll use to offset that tax charge in the year, but the charge obviously still remains. And next slide, please, Hannah. So some of the key movements on the balance sheet to give some narrative and explanation to those. So we will show a IAS 19 UK pension asset that's increased by 12.8 million to 26.8. That significant increase in the asset is driven by movement in discount rates. For our scheme, that's moved from 1.4 to 1.9%, so just a 0.5% movement, main driver there. So it gives a bit of context to the impact from small changes in discount rates to the surplus that we're reporting. There's a small increase in inventories, a couple of drivers there. One, we're expecting revenue development in the second half, so the profile of parts and materials ordering in advance of that reflects that anticipated increase in revenue, but also an element of it relates to stock management to mitigate lead time pressures from the supply chain. Then the two larger movements in the balance sheet relate to trade and other receivables and trade and other payables. Pretty much all of the movement is associated with the positions of overtime project and contract balances and long-term contract accounting, to use a phrase in the past. So I've mentioned previously that we received significant values of deposits on projects at the back end of last year. That explains, as those projects unwind, that explains why the movement in trades and other payables has decreased as those deposits moved from a credit balance in the account flushing through. And as the deposits unwind, there was also an unwind in contract assets, which were built up and mainly built up from unbilled revenue. And as that revenue flushes through the accounts during the first half of 21. I mentioned working capital movements, and I think it's fair to say, as a contract engineering, contract manufacturing business like Mpac, the frame of reference where you're comparing to and from makes a huge difference to movements in working capital. If we compared the position from September last year to March this year, it would have been very minimal working capital movements, but because of the timing of deposits and the timing of contract balances, it does show a significant movement in the first half of this year, albeit in line with our expectations. Perhaps move on to the next slide, please, Hannah. And yeah, there's an overview of the cash bridge. You can see there on the right-hand side. We started the year with 15.5 million of cash. EBITDA in the first half was 5.7 million. The drivers to that we've spoken about, and working capital increase of 7.2 million offsetting that. Next is our ongoing commitment to pensions and our UK and US schemes. Next chart on there is the CapEx. The next slide, next bar on the chart is CapEx, which was relatively light in the first half. And we had said previously that we were getting to the end of the investment cycle. We'd spent heavily on implementing business systems to move the group over to operate as one Mpac in that single business model. And that investment cycle came to an end at the early part of this year, and the focus now very much so moves forward to leveraging that prior investment, and I think we're seeing some of those first shoots from that investment coming through. So to the left hand side, I'll close off on the financials by giving an overview on our borrowing facility. So we have 10 million borrowing facility. It's unutilized. We're debt free, albeit a small caveat that there's 900,000 of preference shares, but we still have a strong balance sheet. And working capital movements aside, which are planned for and which are expected, we have sufficient funds and sufficient access to funds to meet our long-term strategic growth plans. And with that, I'll pass you back to Tony.
Yeah, thanks, Will. So just to summarise then, and to give you a little bit more colour around the outlook, you know, and you can hear from today's numbers that we're really confident that we can deliver on the expectations for this year, and we're very well set up now for 2022 as well, with the continued positive trends on the order book over the last couple of months. Mpac has demonstrated a return to growth, and all the trends are in the positive direction, which is you know, really reassuring as well. The order book and the pipeline of prospects into the essential healthcare and food and beverage sectors continues. And these are inherently robust markets. We're finding through the pandemic, yes, the healthcare slowed down a little bit, but still has recovered very quickly. Food and beverage, seemingly went straight through. And we've got this, fantastic opportunity in the energy storage area, which we'll carefully look at in the coming months and be able to report back to you at the next session of, where we really see our position going forward there. I'm excited by the opportunities with Switchback with a new facility, 3 times the size of the old one, and they're continuing their growth story and showing great capabilities to keep delivering on that. So we're going to continue to focus on our strategy, keep rolling that out, keep delivering against that strategic intent. So organic growth is clearly a key part of what we do. We continue to look at acquisitions. I think I've reported to you previously that the things that we're looking at are not on the market, so the company is not prepared for sale, and therefore it can be a long and twisty route to talk to the owners of those businesses and get them into a position where they feel it's the right thing for them to do. I think we've got an advantage because we are a strategic partner rather than a lot of them have a real aversion to private equity ownership. And Mpac is very well financed with a strong balance sheet and is well positioned to continue this growth story. So, really appreciate your attention today and participating in this webinar. I'll pass you back to Hannah, who can moderate the Q&A.
Thank you both, and we've got a number of questions, so let's get cracking. Could you go into a bit more detail about the FREYR contract, how this came about, and whether you see the possibility of other customers in this area?
Well, I think, as we covered there, we've been working on this for 4 years with 24M as the technology provider. FREYR has picked up on the technology and put their business cases together and developed themselves as a business to deliver that in Norway, but for the Western world, as they describe it, because China is dominating that market, and they'll surely look after their own requirements first before they'll be offering their production capacities to other countries. So, it's not something new; it's something that we've been working on. The contract is a development line, which we got the order in July, around £9 million, and it's scheduled to be delivered about this time next year. So it's a long-term project, but obviously, talking to FREYR, and their CEO describes our partnership as joined at the hip. Their success depends on our success. And if we look at their published plans on growth, and they deliver against them, and we continue in this relationship, there could be multiple orders for lines in the next 12 months or so. But we just a slight cautionary note on that because it's a new line with a new customer. Is there other people in that space? There's a lot of them. You can do your own research. These are, more or less every other week in the UK, there's another battery energy story coming out of the automotive belt around Birmingham. Coventry Airport's apparently been bought by somebody putting up a gigafactory. Sunderland the same. But we have to then look in more detail about what technology, and we think the lithium-ion technology is a real differentiator because the cost of unit production is lower and the energy storage capacity is higher, which is why the 24M technology has an advantage. And that's the business case that FREYR are following. Now, FREYR is not the only licensee. There is already a company in China who's got the license to produce the same from 24M. And we're talking to a potential client in the Americas as well for the same. But this could be rolled out in multiple areas. I think, again, we don't want to get expectations carried away with themselves. We need to just keep our feet on the ground and do our analysis while simultaneously delivering on our commitments. Let's never underestimate that we've got our day job to do as well.
Keeps you busy, I'm sure. Excuse me. Like-for-like revenue, that's excluding Switchback, appears to be marginally down year on year and significantly down compared to the second half of 2020. Growth in the Americas has perhaps offset some of the weakness in EMEA. To what extent is this down to the inherently lumpy OE revenues, large sales booked post-period end, or temporary factors in these markets and longer-term trends?
Well, I think we'll double hand that question. I'll first of all talk about the general market conditions, and I'll let Will talk about the specific numbers. It depends what period you're comparing, but the like-for-like revenues are up against last year, the comparable period. And it's mainly driven by the Americas, as I think we've pointed out in our presentation. And why? Because the American market has just been a lot more open during COVID. People have been moving state to state. They didn't have a very long lockdown period, if at all. Certain states have been more conservative than others, but by and large, they've been very pro-business, pro getting on with things, pro carrying on. And European markets have been much more conservative with travel restrictions, with just business. We're only just now starting to travel. I was in the Netherlands yesterday, and it's quite bureaucratic. You've got to really want to travel. So I think there has just been headwinds and things for the European market. So I think that strength, we can see the different regions. And then we talk about the food and beverage against the healthcare. Food and beverage, again, been very strong in the US. And when you look at the existing business, it's Switchback has had a very positive impact on our business, and the Tadcaster facility, Lambert, has had a slow order intake in the last half year, but that's now recovering. So it's a mixed bag, and it's very difficult to draw very straightforward conclusions from that. It depends on our customers' investment cycles and where they're at and where geographically their plants are. So I'll pass you across to Will, and Will can give a little bit more detail on the numbers.
Yeah, okay, thanks, Tony. So you're correct. Like-for-like revenue is up slightly, marginally up on the prior year. And across the regions, we're seeing a different profile for revenue development and different degrees of utilization of the resources we've got across the group. But the profile into the second half of the year is very strong. The order book is very full, and we expect with that profile of order intake more evenly split between regions and per sites, we expect for there to be a strong acceleration in the second half, and that's reflected in the numbers that have been released today by analysts with an upgrade to the forecast for the full year.
Well, while you're in the hot seat then, Will, how much the increase in gross margins then, how many of those factors you've just touched on are sort of feeding into that in terms of service mix, geographical mix?
The increase in margins in the first half,
yes.
Yeah, well, it's more down to, well, the first point is that mix of customer margins. We quote project by project, so margins can vary between customers and between different projects. So the mix was strong in the first half of the year, and clearly that's our goal, to focus on taking cost out of project execution and to improve efficiencies by leveraging the group's resource. For us to be able to hit the revenue forecast and to be able to deliver that growing order book, we absolutely need to be able to consider our operational resource pool as one resource pool, and that investment in one Mpac business systems absolutely gives us the ability to be able to do that, and that's going to be one of the key factors over the short to medium term going forward to hit that 10% return on sales target. That's aspirational target, but we're putting the metrics and putting the conditions in place to be able to deliver that.
Thank you. Are there still packaging sections within your offering where you consider there still to be a gap?
They're always going to be that. I know our industry, as you see on the slide, is over $40 billion a year is spent on packaging machinery and automation equipment in those two sectors. So there are always going to be gaps. What we're trying to do at Mpac is work within the sectors where we've got strengths and their adjacencies and build out our product line to better service our customers in those sectors, rather than leaping to a completely new area where we don't have expertise. And I'll give you an example. We've looked at a couple of companies around dairy products, packaging of dairy products, which is quite a strong area as well. But we just don't have experience in handling of dairy products. So it's something that you think, the time it would take us to understand and to become competent and a leading player in that we may as well look at the areas where we're already well positioned, expand our product portfolio, which was what we've done with Lambert and with Switchback, and enhance that with other in-house developments with the cage packers, Industry 4.0 solutions, to really be able to maximize the sort of share of wallet from our existing customers.
Okay, now I've got two questions here on dividend. One's clearly angling for one, and the other one suggesting you should invest in the business. So could you expand on the board's thinking regarding dividends?
Well, you know, we've communicated a couple of times now the same thing. The board will always consider every opportunity should we be paying a dividend, and the basic rationale there is, are we generating positive cash? And as you can see from Will's presentation, there was a net outflow of cash in the period, so that is technically in our sort of discussions a barrier to paying a dividend. We are conscious that we've been through a journey to turn around the company over the last 4 or 5 years and get to a level of sort of maturity to say, and Will's starting to talk now about, you know, definitely we see the profitability level being more than sustainable and growing. So we are, as a board, very open to moving to a dividend policy. Well, we've got a dividend policy, but moving to a dividend situation going forward. But we want to remain cognitive of the positive cash generation, but also having the ability to move in the acquisitions. So cash for acquisitions and internal development is still really important to us. A long answer, but hopefully that gives you a flavour for what we discussed as a board.
Thank you. A couple of questions on pensions. Why are pension admin costs continuing to rise when you would assume the number of members in the scheme are falling? Is it one-off? And also clarify the UK pensions asset of just over 28.5 million on the balance sheet. Is that something that gets released to shareholders?
Oh, okay, well, take the first one, pension admin costs. There weren't any one-off unusual costs in the first half of the year, other than the fact that the trustees and the pension scheme were getting ready for the triennial valuation, which began in June 21. So there was some additional advisor fees and professional fees associated with that process, and that goes through a cycle every 3 years, obviously, and that's something which is difficult to avoid. The trustees need to be appropriately informed and appropriately advised as they approach that cycle. So nothing unusual there. And in terms of whether the 26 million would be released, well, no would be a short answer, but what we're facing here is a basis for evaluation of a scheme which shows a very big surplus on an accounting basis, and then an actuarial basis which has a slightly different lens and a more conservative view of the assumptions, and shows, based on the last valuation, a 35 million deficit. So yeah, accounting rules state that we show and report the surplus based on IAS 19 criteria, but that's not a real surplus that we can get our hands on. We're still having to make deficit recovery payments to fund the actuarial deficit that sits, albeit not shown on the balance sheet.
Helpful canter through. Well, perhaps a little follow on here. Why do you exclude the pension management costs from underlying EPS, as surely they are ongoing?
Yeah, they have been ongoing for some time. We would very much like to get to the point where we are no longer funding the administration of a scheme and we can decouple it. But truth be known, the answer here is that we've got a legacy method of accounting that won't. There's no trigger for that to change. We're very transparent with the costs associated with managing the pension scheme. I think we put it in this presentation. It's referred to 3 or 4 places within the announcement. So we try to be as open as possible whilst sticking to the accounting or best practice for disclosures of accounting within our financial statements.
Back to the business then. Someone's asking for some clarity on what's happening in the Asian business, in particular India, where service has been cited as an issue due to COVID and equipment sales out of Singapore.
Well, Asia's starting to recover. We're seeing that. Asia has been, I think, disproportionately impacted by COVID. They were the first into the pandemic and are still not moving around, traveling freely, although the order intake has started to pick up from that region for us, particularly in high value spirit bottles. So the packaging of spirits is what we're seeing. India is a very small footprint for us. We generally deal with companies in India that are global FMCG. So, you know, there is a high barrier to doing business in India because of import duties. So our business tends to be through global OEMs. So I don't know where the India question's coming from, but our Asian business is starting to pick up. It's a relatively small part of what we do. And that's been quite a strategic, conscious decision over the last couple of years. We knew that we were underweight in the USA, in Americas, and we invested quite heavily there, and we can see the benefits of that over the last 2 or 3 years. We know there's more to do in EMEA in terms of the core markets, and I think once the business is showing its true potential in the Americas and EMEA, then we can turn our attentions to the Asian market following that. So at the moment, we're still very much servicing our global customers in Asia and offering that full solution to them.
Okay. Why did you move from Coventry to Tadcaster, and what are the financial benefits and costs of the move?
Wow, yeah. When we acquired the Tadcaster business, we made it known then that we wanted to create a business with momentum and scale in the UK. The Coventry business was subscale, and we saw the opportunity because the businesses were very similar in terms of the customer base and the solutions and the technologies. So we thought that was very complementary. So bringing them together, and we discussed it with all our major customers, and they were delighted to do that because they always felt that the Coventry business was vulnerable for them because there was not so many people, and if key individuals decided to leave the company, it could leave them a little bit exposed. So I think by and large the customers have been very pleased with the move. We then obviously didn't have much going on in the Coventry business, so we put the building for sale. We had our headquarters still down there. We subsequently sold the business last month, or the buildings. So now we've decided, and we have moved the headquarters to Tadcaster, so we can really concentrate on the one site in the UK, be close to the business. I think from the ongoing savings, I'll pass that across to Will. You can add some colour to that.
Yeah, sure. Okay, ongoing savings probably in the regions of £200,000 to £250,000 a year. Not huge, but we're taking most of the cost and relocated that to Coventry, so it's really the cold and facilities costs that were left. So that's an ongoing saving. In terms of the sale, contractually that will be completed in the second half of the year, and after all costs associated with the sale, that will be something in the region of about 300,000 profit that we'll recognise in the second half of the year.
Couple here on the land in Berkshire. Are you continuing with any planning consent? What's it on in the value of the balance sheet versus perhaps what you might think it's actually worth in real life?
Yeah, Will, do you want to pick that one up as well?
Yeah, okay. Well, it is Buckinghamshire. We went through the application, I think 2018, 2019. The change of use wasn't permitted. We're advised that the appropriate time to put the application back in for that would be somewhere between 3 and 5 years after the previous application went through due process. So in the meantime, there's no activity on the land per se, and we remain close to our advisors to make sure we're informed of any changes that come up before that timetable. But that's what we're presented with at the moment. In terms of the carrying value, well, the carrying value in the books is relatively small, and we own the land and we own one of the properties adjacent to the land, which would help in the event that we ever got planning permission to provide access to the land. They're in there at fair value, and anything regarding future value of the land with permission would dip into speculation. So what we can say is it's 10 acres in Buckinghamshire, and I think probably anybody who was really interested could do some research and see what 10 acres in Buckinghamshire's residential land may be worth, but it's in the books at fair value.
Okay, thank you. Right, well, I'm conscious we've gone over the hour, so I will both let you get off to your next meeting. Thank you both very much for your time today. We'll look forward to hearing updates, perhaps acquisitions in the pipeline, which you touched on may or may not come through, but best of luck on your continued journey.
Yeah, thanks, Hannah. Thanks, everybody.
Thank you.